If you're doing a backdoor Roth IRA strategy, you know there's a wrinkle when you have pre-tax dollars inside of your IRA. The question is, what happens if you inherit an IRA from someone? Does that disrupt your backdoor Roth strategy? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. The backdoor Roth IRA strategy can be a great way to, an advanced way to get dollars growing tax-free for your financial future when otherwise you wouldn't be able to. Here's how it works. If you are earning above a certain threshold, okay, married, filing jointly above, 240 some thousand approximately in there. If your adjusted gross income, modified adjusted gross income is above that, you actually are not allowed to contribute to a Roth IRA directly. And the benefit of the Roth doesn't give you a tax deduction today, but all of the growth on that account is tax sheltered and tax free if you take that money out when you're 59 and a half or after, and you've had a Roth IRA for at least 5 years. So that's the benefit. And if you make too much, you can't do it. So what's a different way? Is there a more creative way? And there is. It's called a backdoor Roth IRA. And where instead of contributing to a Roth IRA, you contribute to an IRA. And you might say, well, isn't there an income threshold on that? No, there isn't. Anyone, as long as you have earned income, can contribute to a traditional IRA. The question is, do you get to deduct your contribution or not? And if you have a 401k or a retirement plan at work that you're using, and you earn more than a much lower threshold, and then you can't deduct it, but you can still contribute to it. It would just be after tax. So you then contribute to your traditional IRA, but you don't get to deduct it. And then because you've now got this after-tax money in your IRA, you then convert that money to your Roth, and there you have it, a two-step process of getting money into the Roth that's growing tax-free for your financial future. Oh, if it was only that simple, right? You guys know that one of the big challenges or wrinkles with this strategy is if you already have pre-tax dollars in an IRA. If you already have pre-tax dollars in an IRA and you add after-tax dollars, you can't just grab the after-tax dollars and convert those. You can't. When you do a Roth conversion, it's proportionate. Okay, what's your total aggregate IRA balances? What's the total? And then what's the ratio of pre-tax versus after-tax? And when you do a conversion, it's that ratio of pre-tax to after-tax that determines the taxability on that conversion. So say, for example, you've got $100,000 in a pre-tax IRA, and you add, just to make the math easy, you add $5,000 in an after-tax IRA contribution. So now your total IRA balance is $105,000, and you want to convert that $5,000 of after tax over to your Roth. There's going to be a ratio, a percentage of 100 divided by 105. That's going to be the percentage of that $5,000 that you just converted. That's going to be the percentage that's taxable to you. And you thought, oh, I'm doing this Roth conversion, it's not going to be taxable because I'm just going to use my after tax balance. And no, that's not true. Oftentimes when people hear this, their eyes roll in the back of their head, they fall asleep. I'm just kidding. It's confusing. Oftentimes people, when they get this, they say, I know what I'll do. I'll have all my pre-tax money over in an IRA at this company, and I'll just open a separate IRA over here, and I'll put the after-tax there, and I'll just convert those dollars. That would be logical. But no, there's a rule where all of your IRAs are aggregated. Doesn't matter where they're held, what company, they're aggregated for this rule. So there's no loophole with it. Backdoor Roth IRAs get very, very complicated, and maybe you shouldn't even do it if you have pre-tax money in an IRA. I told you all of that so that I could tell you this. Here's the question, especially with what we're going through for the next 2 decades, the great wealth transfer and people, passing away and leaving wealth to the next generation. Well, how does this work if you inherit an IRA? If you inherit an IRA from a spouse, then it becomes your own IRA, okay? Most people choose that. But if you inherit an IRA from a parent, say you didn't have any pre-tax IRAs, and you've been doing this backdoor Roth strategy like clockwork, and you intend to continue to do that for the foreseeable future, and that tragically, awfully, just emotionally, your parent died, your dad died, and you inherit some of dad's IRA. 50% goes to your brother, 50% goes to you. Now you've got this inherited IRA that dad never paid tax on. Now you have pre-tax money in an IRA. Can you still do a backdoor Roth? Does that inherited IRA count towards this aggregation rule? I wouldn't be surprised if in the future it did. I wouldn't be surprised if they are changing something right now so that it would. But from what I can see, no, it does not. It would not disrupt your backdoor Roth strategy. You're in the clear, and here's why. Here's the logic, and this is why I hesitate to say, no, this is definitely the rule. It will always be the rule because it's logical. And oftentimes we get a lot of tax rules that are illogical. When the IRA aggregation rule for this Roth conversion, it's your IRAs, no matter where they are, no matter which company they're at. All of your IRAs are aggregated. An inherited IRA is not your IRA. It's still, in this example, dad's name for the benefit of you. Dad's name for the benefit of you. It's an inherited IRA. It's still dad's name, designated beneficial account for the benefit of your name. And because it's not your account, it's not counted in this aggregation. Therefore, based on how I understand the rule, and this could change, that when you have no pre-tax IRA dollars and you now inherit one, it doesn't disrupt your backdoor Roth IRA strategy. Keep in mind that an inherited IRA right now is now going to fall under the 10-year rule, where you'll have 10 years to withdraw that entire account, then and it'll need to be emptied by the end of the 10th year after death. And also, if the individual that you inherited the IRA from has already started their required beginning date, starting right now, this year, you are required to take a minimum distribution from that account every single year. What's that minimum distribution? Logically, it would just be take the account divided by 10, since it's a 10-year rule, and that's what you need to take out. It's not that. It's based on your life expectancy, so it's a little bit. And if you just take out your required minimum, you're not going to have the account emptied in 10 years. So there's a little bit of planning and thoughtfulness that needs to go into your strategy there. So work with your CFP on that, or work with your CFP on whether a backdoor Roth IRA strategy makes sense for you. And if you have some pre-tax IRA dollars, what could be done creatively to help you manage that and still take advantage of the backdoor Roth? Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go on, take your next wise step in your financial life.